This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Today is March 21st, 2021. The major stock market indexes are near their all-time highs, but traded off slightly last week on continued inflation concerns. The equity markets have been positive this year on the expectation of the economy accelerating as more businesses around the country are able to fully open. So far this year, the best performing stocks have been those most affected by the disruptions of the coronavirus pandemic. The vaccines are being effectively distributed in the U.S., with now more than 24% of the U.S. population having had at least one shot. With an average 2.4 million vaccinations per day and growing, it's estimated that 70% of the country will be vaccinated by mid-June. Even travel bookings, still well below pre-pandemic levels, are starting to accelerate. With the distribution of stimulus checks from the American Rescue Plan, economists expect to see a sharp rise in consumer spending in March after weakness in February, which was attributed to foul weather for much of the month. Retail sales were down 3% in February after a 7.6% gain in January. The U.S. equity markets are generally outperforming the rest of the world, but everyone is benefiting from increased economic activity. Nothing highlights the expectation better than the significant outperformance of the Russell 2000 Small Cap Index. Small companies are more impacted by strength or weakness in the overall economy than larger companies. Small firms lack the resources to weather difficult economic periods. On the flip side, their growth rates accelerate much faster when the outlook improves. The strength in small cap stocks is a clear signal of investor expectations for the economy. As we emerge from the global recession, the combination of massive stimulus and reacceleration in demand is putting upward pressure on interest rates from historic lows. Higher interest rates are having a negative effect on bond prices, taking both the U.S. aggregate bond index and the global bond index negative so far this year. And the slow vaccine rollout in Europe and continued shutdowns with an ensuing third wave of infections is holding back European equities. Even further behind are the emerging markets, where much of the vaccine rollout has yet to even begin. Despite a sharp sell-off in energy last week, the sector is still the best performing sector in the S&P 500. Crude oil inventories were higher than expected, prompting shares to retreat. At 12 times earnings, energy stocks continue to trade at a steep discount to the rest of the S&P 500. And financial services, the second worst performer in 2020, is the second best performer so far this year. The prospect of rising interest rates has pushed the sector higher. Higher interest rates give more leverage for financial institutions to profit on the spread between deposits and lending. The pandemic, regulation, and low rates have all kept valuations for the financials at historic lows. The sector is the least expensive with a PE ratio of 11 times earnings. With the prospect of recovery and continued success for many of the technology companies that thrived in the pandemic, we are taking a barbell approach this year, investing in both the value companies that underperformed along with the growth leaders. Analysts and economists are expecting the economy to be very strong for the foreseeable future. As we pointed out last time, the consumer is generally in very good shape, and there is significant pent-up demand for goods and services. There have been significant increases in earnings estimates for the S&P 500 for 2021 and 2022. As you can see on the chart here, earnings this year are expected to exceed the pre-pandemic results of 2019, with a continued acceleration into next year. Earnings in 2020, the worst of forced shutdowns, declined 22% from 2019. By comparison, earnings in the 2008 recession declined 40% from 2007. So this time around, the recovery is expected to be much steeper given the strength of the consumer, better unemployment situation, and massive stimulus being thrown at the economy. Earnings ultimately drive stock prices, and the markets have been anticipating the reopening of the economy for some time. Despite the big upward earnings revisions, stocks do not appear inexpensive, however. Since the end of last year, the estimate for 2021 earnings has been revised up $8.04. That's a big upward revision. Analysts forecast approximately $200 in 2022, representing a 16% further growth from this year. Assuming growth can be that strong, $200 in earnings puts the S&P 500 at nearly 20 times earnings. With a historical average of roughly 18 times, the market's not inexpensive at current levels, even with the positive economic outlook. It may be that there will be further upward revisions to the forecast, pushing the market even higher, but there are some risks, including inflation, unemployment, or the possibility of further unexpected economic impact of the coronavirus. With the expectation of a strengthening economy, investors have grown more concerned about inflation. Last week, Fed Chairman Jerome Powell reiterated that the Fed is focused on keeping rates low. Federal Reserve forecast expects U.S. growth of 6.5% in 2021, which is a big revision up from 4.2% previously. Inflation is expected to reach 2.4% and for unemployment to hit 3.9% by the end of 2022, and all this without having to raise rates. Despite Powell's reassurances, bonds continue to sell off, resulting in the 10-year Treasury ending last week at 1.71%. Rising rates won't just impact high PE stocks, but the housing market as well. After ending 2020 at a low 2.65%, 30-year mortgage rates are now back above 3%. The Fed's goal is to reach full employment. Its forecast is for unemployment to reach 3.9% by the end of next year and return to pre-pandemic levels of 3.5% at the end of 2023. Unemployment for February was 6.2%, down from 15% at the height of the pandemic shutdowns last year. Improvements in unemployment have been slow recently, with new claims unexpectedly rising 45,000 last week to 770,000. Although continuing unemployment claims, people on unemployment still requesting benefits, did improve. Clearly, the employment picture is still disrupted by the pandemic and will take much of this year to calm down. So this briefing is a work in process for us. Our thought was to spend our time initially on the macro outlook for the stock market and for the economy, and we thought we finished looking at an individual stock. Plug Power is a manufacturer of hydrogen fuel cells. Currently, the fuel cells are being used to power forklifts at large warehouse facilities for customers that include Amazon, Walmart, Nike, and Home Depot. The company went public in 2002. Plug Power is an early-stage company. It's very speculative. The company is not profitable, but has rapidly growing revenue. Last 12 months, sales were $307 million and grew 80% over the year-ago period. In the last 12 months, the company lost $100 million. The demand for cleaner energy solutions, particularly for industrial applications, is a significant market opportunity. Since it is a speculative stock, we have limited investment in the company, but we do have some positions. Anyway, the company was trading at $3.42 this time last year, and in the euphoria for alternative energy stocks, it hit a 52-week high of $75.49 earlier this year before closing last week at $38.28. To make things even more complicated, the stock was weak last week on the announcement that the company would restate its financials, including a reclassification of some of its expenses. Restatements of financials are never good. They erode confidence in management, although in this case, the restatement is non-cash, does not affect revenue or the balance sheet, and has no impact on the company's sales projections. Plug Power says they expect $475 million in sales in 2021, $750 million in 2022, and to hit $1.7 billion in sales by 2024. After the election last year, green energy-related stocks took off in general with the anticipation of favorable incentives from the new administration in Washington. It's always hard to forecast how public policy may impact industries. We don't like to speculate on potential political impact on stocks. But regardless, the outlook for alternative energy companies is compelling. It's just difficult to tell at this early stage which companies will be standing even 2 years from now. Plug Power competes with Bloom Energy and others, for instance. The stock has had a nice pullback. If the company can hit its sales targets, the $1.7 billion in sales in 2024, that would move the stock higher. For now, we're simply holding on to the shares, but we think it is worth watching and maybe opportunity on a further pullback. Anyway, thank you for joining us. I'm Greg Vogel. I look forward to seeing you next time.